Welcome back to the Beyond Ordinary podcast. We'll connect with great people doing great things to inspire you to do the same. We are going to talk everything real estate investing. I got my man Lane here with me today. How you doing today?
Hey, thanks for having Miles. Hello, everybody.
No, no problem, no problem. So, first question, is now a good time to buy an investment property given everything economics, interest rates, all that stuff?
Oh, well, I mean, depends on what you're buying, right? Like, I
Mm,
think residential real estate um, has been strong, but that as an investor, you need to be a contrarian investor, and that's probably not the best time to be going in when the crap table is hot. You want to go buy things when they're a little bit on discount. I'm more on the commercial real estate side. Commercial real estate has seen a price correction of 20 to 30% off the highs of a few years ago. Um,
mm.
Not saying that it can't go lower or double bottom, but typically you don't see that type of stuff outside the stock market.
And then you said you're more so into the commercial real estate. So what made you want to go like more so commercial as opposed to residential?
Yeah, I mean that's residential. I think is a good place to start, right? Because it's
Mm,
a lot cheaper. I started out buying little rental properties. The first property I bought was a place to live myself, and then
yep.
I just rented it out, and that was back in 2009.
Oh wow.
And that was kind of got a property manager, paid him 10% of the rents to run it for me, and I was off and rolling. And I just kept working my day job. I was an engineer at the time,
Mm,
so I was able to, save my money and buy up the next property with 20% down payment, and then just rinse, wash, repeat over the next from 2009 to 2015. Got 11 rental properties, and then obviously scaled up from there.
so as you were scaling with 11 properties, that's a lot to manage. Were they all in the same area, different states? Like how did that work?
All different states. A lot of these I never even visited in the first place. That's you start to learn how to use property managers to do your dirty work for you.
Hmm.
The property manager's job is to find a tenant for you and then manage that relationship. When things break, they're the ones who get it fixed. Why are they doing that? Well, they typically take 10% of your rents, and then when they lease up a new tenant, they might take half or all the first month's rent.
Mm, okay.
So they're not doing it for free, man.
Oh yeah, yeah,
Yeah.
of course not, of course not. So how did you manage? Because I'm assuming you had to get multiple property managers if everybody's in different states. Like, how did you go about evaluating your property managers to make sure that they did what they needed to do, or that they were actually good candidates?
Yeah, I mean, most property managers aren't very good because they're just realtors who suck at their realtor job and can't sell houses, right? The people who property management, I think, is one of the worst or hardest professions to be in
Really?
because it's
Wow.
not super high paying, but man, you got to deal with everybody's BS, right? Especially like
Right.
the tenants and stuff like that. And so, yeah, to your question, it's like it's super hard to find a good property manager. And like anything else, it's all referrals, right? So you got to
Hmm.
get in there, meet other people in the business, see who they're working with. That's the one nice thing, it's not like landlords are like competitive with each other. You're like, oh, take my tenant. No, we're all in this together, dude, right? Like,
Yeah.
I don't care if your house is right next to my house, right? We're all in this kind of together. So it's actually easier to kind of find referrals in the real estate world.
Hmm.
Um, but that's kind of how you get started, right?
Okay. Referrals and stuff. Okay, that's cool. And then in terms of like actually, buying these properties, how do you evaluate whether a market is worth investing in?
Yeah, I mean, a lot of it is by the numbers, but starting from a high level, we like to focus in on red states. When you're the landlord, you want the landlord laws on your side. So,
Right.
and then the second thing, we look for more secondary and tertiary markets. So we stay away from the primary markets, which are the sexy places to live. DC, where you're at, I
Mhm.
think that's a blue area too. Um, Seattle, California, Hawaii, all places that are just too expensive from a number standpoint. And then we look for we try to buy not in the best areas because it's just going to be not too expensive, and
Mhm.
obviously not in the war zone areas. So there's a nice little sweet spot in the middle. And
Mhm.
yeah, we I think at that point, you've probably knocked off majority of the American cities and locations out there. It just
Right.
comes down to
Exactly.
numbers, right?
Mhm. And then, so what numbers are you like numbers or KPIs or whatever are you looking at in terms of
Yeah.
evaluating the
So
markets?
so first thing first, like real high level, this is real basics, like the rent to value ratio first. So we're looking for something that's like about a 1% value. So you take the monthly rents divided by the purchase price,
Mhm.
and that's the equation right there.
Okay.
So probably at DC where you're at, maybe a starter home would be 400 grand if you're lucky.
Right.
Probably want to be the best rental, but to rent that thing out, you get maybe a couple grand, right? 2,500. That's much less than 1%. That ain't gonna work. Not gonna work. Yeah. So, and that's where like I bought my first few units in Seattle in a high
Mhm.
price area, and I didn't know any of this type of stuff. And so it took me a pivot to now start to invest in Birmingham, Atlanta, Indianapolis. So I had five in Atlanta, four in Birmingham, and one in Indianapolis.
Mhm.
And these are more secondary markets, better cost effectiveness. Maybe not doesn't appreciate as much,
Right.
but that was the angle I went, was more of a cash flow investor basis starting out.
Mhm. And then once you pivoted, so scaled up to 11 properties, probably more. How did you make that pivot from what's it called, residential to commercial?
Yeah, so this is it took me a long time to get up to that stage, right? I mean, once you get
Mm.
become more of an accredited investor, net worth $1 million or greater, or for some people who make a high income over 200 grand, you're kind of known as an accredited investor. You can get access to better deals. And part of it is, when your net worth is $1 million or greater, you're kind of more of a liability to get targeted for a lawsuit. So you don't really
Mm.
want to own all these rental properties, even if you do hold them in, LLCs or
Right.
entities. You're just, at the end of the day, you're the walking fool who is at the liability of these things if somebody slips, trips, or falls. So I didn't know any of this back at the time, but I just started to interact with more accredited investors. Like I myself, my parents never owned rental properties.
Right.
I didn't have any rich uncles or accredited investor friends. I just kind of haphazardly connected with some folks and met people, and and just kind of started to learn about a lot of these strategies that I wrote about my book in the Wealth Elevator. Right, there's a lot of books out there written for guys getting out of debt. um you know I don't know any of that stuff. I was just lucky because I had a good paying job and I was pretty frugal with my money and able to stack my chips up and get to a credit investor status and head off from there. And that
Mhm.
was, essentially, you know, you start to realize that there's actually better deals in the commercial realm when you go above a certain, several $1 million threshold, because the single family homes are the most competitive asset class
Yeah.
out there because every Tom, Dick, Jane, and Harry buys those things.
So it sounds like in order to become accredited, you just have to have what the net worth, and I'm assuming some sort of like connections and stuff in order to really break into commercial.
Yeah, I mean, you can buy commercial properties without being a credit investor, but I think a lot of investors, like I myself, like you're looking to go into a commercial real estate deal, but also not put all your chips into the deal,
Right. Of course.
right? And this is kind of where I realize, people call this syndications or private placements. They can also call it like the country club deals,
Mhm.
right? Where you go in a deal with a bunch of your friends, people put in 50, 100 grand each with 50, 100 other people, and you take down a deal amongst as a group together.
Mhm.
And what this allows investors to do is go in as an LP position for liability reasons, but also diversify in different geographic areas. Buy an apartment in Atlanta, buy an apartment in Dallas, and then also get into other types of asset classes: apartments, self storage, mobile home parks, even buying businesses and private equity. Right? It's kind of boundless at this point and allows you to diversify, which is a key cornerstone of anybody's portfolio.
Oh,
But the key
absolutely.
here is investing more directly with the asset as opposed to going through the many middlemen of your traditional investment pathways.
Mhm. And then can you explain further like when this indication is and like the benefits and of that?
I mean, the syndication, I mean, the analogy I like to use is like an airplane. When you
Okay.
get in an airplane,
Explain.
there's a cockpit, and you have the co-pilots, pilots. In our world, we call them the general partners, right? These
Mhm.
are the operators that find the deal, manage the deal, get the lending, do everything.
Mhm.
And then the investors, like in the airplane, the passengers, they just come on, they just invest and they go to sleep, take a nap, and they're able to diversify. And the nice thing that rounds this whole analogy up is everybody's on the same airplane, right? So the general partners
Right.
have kind of skin in the game.
Right.
But if the airplane goes down, they take the reputation hit and the wallet hit too, a lot of
Mhm.
times. So it allows people to go on these ventures with each other and also many of them, right? To get that diversification speak. But if you're noticing, like, and I think this is a big aha moment for a lot of people is like your traditional investments, like REITs, for example, real estate investment trusts.
Mhm.
They invest in the same damn things that syndications will, but the REITs will have a lot more overhead. You know, how else are these certified financial planners? Like they're just salesmen
Mhm.
at the end of the day to sell you stuff. And then how else do these big firms have these huge buildings? You know, it's coming ultimately out of your pocket, right? From hidden fees and expenses.
So what I'm hearing is that syndication is essentially just like a almost like a mutual fund, but like specifically for real estate and real estate investing.
Mutual fund, technically, I mean, not to be like techno, mutual fund is kind of like a fund of many things,
Right.
right? But a mutual fund is a traditional investment vehicle where there's a gazillion middlemen in there
Mhm.
too. I would say it's more like a syndication is more grassroots, right? You're cutting out a lot of the middlemen. You're getting investing more directly in the asset,
Mhm.
right? But you can be in a syndication that's a fund that invests in 50 apartments. Ideally, I like to invest in things that I know what I'm investing in. You know, 123 Main Street, that apartment.
Absolutely.
So I know
Mhm.
what I'm investing in. And it's a lot more transparent, I think, what's going on instead of all this chaos in terms of financials. But um, that's kind of the idea, right? But then it puts the onus on the investor to go out and get their own diversification
Yeah.
and to invest in multiple deals.
And that's typically what people don't want. They pretty much want to just be able to be like, okay, who has the best reputation I could just give my money to, and then just know it's safe, you know.
Right,
But
right, which
but
is kind of
yeah,
a cardinal sin of investing, right? Like what you don't want to do is, all right, let me look what mutual fund has been doing well, and let me invest in that. That's like what you don't want to do, but that's what everybody does. That's what retail
yeah.
investors do.
Yeah, and another thing you said that I thought was major key is that you like to invest in funds that you like know about that are like transparent and stuff. Like one thing I think I was watching Dave Ramsey, he had Graham Stephan on, and he was talking about he was just asking him about his like portfolio and stuff, and he started listing off a lot of stuff, and then he was like, "All right, like what do you know like the back of your hand?" And he was like, "Real estate," and he was like, "Okay, you should probably just invest in real estate because it makes sense to invest in things that you actually are knowledgeable about." I think a lot of people are trying to just invest in a whole bunch of stuff and diversify because it sounds good, but it's like, what do you actually know? Like, put your money where you know what I mean, and not just like you said, just blindly trust a reputation or blindly trust like, oh, this person's fund got a 20% annual return. Let me start put my money there. So
Yeah, but I mean, to your point, most people don't know anything about investing or real estate,
that is
so
true.
they probably should just invest in like the standard target fund, date funds, low expense ratio, and just invest in the entire market. But you know, there is a very, very small subset of people out there, maybe a fraction of a percent, that are in the know and are able to get outsized returns and now tap into the tax benefits of real estate
Mm,
directly. And I think the only thing that sets people apart is the education and knowledge which we provide a lot of people into this world. You know,
mm,
you're gonna have to do your own due diligence. You're getting off the beaten path, but it's there for the taking. But as they say a lot of times, financial independence is not for everybody. If not,
damn.
who would get our coffee? Who would do good and get all this shit done, right? Like,
Dang. Financial freedom is not, that's a hot take. Financial freedom is not for everybody.
no,
I would
it's not for everybody, right? I mean, if people just had more cash flow rolling in that they knew what to spend with it, how would society run?
I mean, that is true. Like, I mean, somebody's gonna have to pave the roads. Somebody's gonna have to, work at fast food and Target and Amazon. Someone's gonna have to do it. Like everybody can't be
Yeah.
the CEO or Elon Musk or Jeff Bezos. But
Yeah. Well, I mean, those guys are more business owners, but not everybody can just be living off passive
mhm,
income portfolio. But at the same time, they don't teach us stuff in school.
yeah, I agree. I agree that I have I've been out of school for like what I think it's going on 5 years. 5 years in May, and I've learned just so much from my own private like just in like intuition. Like let me learn about crypto. I've been studying it for 5 years now, following the FOMC, what's going on with interest rates, all that stuff, because stuff that actually matters, as opposed to when I was taking, because I got my degree in finance, as opposed to just memorizing like dumbass formulas that I have yet to use like to this day. And it's like for what? You know what I mean? So yeah, I could go on and on about how
I
much I
hear you,
hate
man.
traditional school.
I hear you, man. I don't know. I don't use anything I do today, but it got me. I think from where I'm coming from, it got me the engineering job, which, like, you can invest in real estate or invest in whatever, but like I know real estate is a very capital intensive investment.
Facts.
I
Yep.
don't care what anybody says, you need money to invest in real estate. You can't just, I mean, that's why people sell these stupid courses to have people go in with no money down. You can't do it, guys. Like you can, I guess, but like from probability standpoint, you're just wasting your money paying the guy who makes these courses to
Facts.
learn that stuff. Like you need freaking money to invest in real estate. It is a big barrier to entry.
Yeah, that a big facts. Like I always tell because my parents been trying to get me to like invest in real estate and stuff like that, and told me I could get a house with like $1. And it's like I understand that like if you the less you put down is just more you're just gonna have to pay later. I mean that's the whole incentive. It's not literally like like a dollar, like it is $1 down, but it's at the end of the day you're still gonna have to pay more in interest in the long term, which is why I don't want to do it.
I mean, not necessarily, man. I
Really?
mean, a dollar. Like, think of it. What I would kind of think of it is like, all right, your parents' time, right? Like, they
Uh,
could buy a house for what, like 30, 40, 50 grand, right?
mhm,
And their mortgage payment may have been like $500. And that was a lot of money to them back then,
mhm.
I bet. But if they would have, you know, but look today, that house is half a mil. $500 mortgage is nothing,
I mean, that
right? So yeah, they paid triple amount of debt, but they were able, like, that's the whole idea of the monetary system is you buy, like, the debt part of the real estate is
mhm,
typically the best debt out there. So you let inflation just essentially erode away your debt. I
mhm,
mean, this is the same practice that the government does, right? We go into like gazillions dollars in debt, and then we just inflate the money supply to make our debt relatively smaller over the years.
mhm. I would say for me, because I'm only 27. I do plan on eventually moving out of DC. I'm not trying to make a really big purchase like a house and be kind of like tied down somewhere. Maybe I could get your take on, renting versus owning. Um, but I mean, I personally just I really just don't want the hassle of having to, find a house, find a home, all this other stuff. And then if I want to move, it's gonna be a whole to do to like sell the house and what to do with all my stuff and stuff like that. So
Yeah, I think
uh,
I think you generally got the idea, especially with people having to move around so much these days for a job. Like you don't want to tire yourself down. And when you buy a house to live in, like you're paying the mortgage. I mean, your money, it's good that it's an asset, but it's not growing very much, right? Your
exactly.
money is probably better off in, regular stock market, which I'm not a huge fan of, or, in your business. Obviously, that's probably where you get the highest ROI. It's also the most riskiest too.
hmm
But the caveat to this is most people should buy a house to live in. You're probably like, what? That doesn't make any sense. This sucker, what he's saying, right? Like, but hear me out here. Most people are really bad with their finances, right? They spend more money than they make, and the house becomes a
Absolutely.
sort of piggy bank. Right? You might
hmm
not be like this, but I bet you got buddies. If they got an extra $1,000 a month, they just blow it, right? If they put it into their mortgage, then it's hard for them to get their grubby hands at that money. So
Yeah.
for most people, they should buy a house to live in because it's a forced piggy bank. Even though it's not the best thing that they could do, if left to their own devices, it's probably best for them. But if, most of my clients, they're high paid professionals making over six figures. More importantly, they're good with their money.
Mhm.
They're able to save at least $10,000, $20,000 a year. So that's a very rare individual. And for that person, and you're probably in this category, Miles, like, you're probably conscientious with your money.
Oh, yeah. I
Take the
regularly
money and don't buy a
invest.
house to live in and invest the rest would be kind of your shtick.
Yeah, for me right now, what I've been doing, I mean, I've been trying to, like I said, I'm 26. I'm been big on cryptocurrency, so like I pretty much invest all my money. Not like I'm not like I'll put it this way. I invest, and I always tell people this. I invest money that I'm willing to lose in crypto because a lot of people only see like, oh, you can make a lot of money, da da da. And this goes for any investment. Like you should only invest money that you're willing to lose because at the end of the day, it could go belly up. It could go to zero, and you don't want to put your rent money in and hoping to double it in 2 weeks, and then it don't go your way, and now you can't pay your rent. But that's not me. I invest decently smart with my money for sure.
Yeah. Yeah. So a lot of that, people never gets like talked through, right? Like people are like, crypto's the best. Let me to the moon. Let me put all my money in this. But yeah, you're exactly right. I think I'm not a financial planner. Apparently I don't have a license to sell people garbage. But they typically will say, if you go on some generic websites, they'll say, you need to diversify and you should go into things that are long term and stable, things that aren't like crypto.
Hmm.
And but the contrary is like, well, if you don't have very much money, you gotta gamble to some extent. Now, I'm not advocating for that by any means,
Hmm.
but I mean, that's it's just like a business. A business is probably one of the most riskiest things out there. But if you don't really have any other options, that may be the best option that you have on the table. And I'm not saying not condoning crypto. I mean, I believe in the technology. Don't get me wrong, man.
Hmm.
But I'm just like I got better things to do my money that I have access to. You know.
Hmm.
But I think that's what's cool about crypto, right? Like you don't have to go through all these middlemen to get at the
Exactly.
investment, right? That's the cool part of this thing.
Hmm. You don't have to pay a fund manager, money manager, anything. You just gotta you could
Yeah,
buy it,
just
own it.
just don't lose your shit, right? Like, don't,
Man, I'm telling you, it's tough. Like I definitely lost it all in 2021. I want to say it was. I definitely lost it all because I mean I didn't know what I was doing. I was basically just gambling. But now that I took the time to like really learn the cycles and actually watch, get an indicator and learn how to use it. It's like, all right, well, I'm more equipped. I'm not saying I'm an expert, definitely not, but I'm just a lot more seasoned, especially like right now. Everything pulled back crazy, and it's like, okay, cool. Well, let me look at the technicals. Let me look at fundamentals. Oh, okay. Well, everything still kind of looks, relatively good as opposed to just, reading headlines on CNN or MSNBC. Like, nah, like I just cut all the noise out and just stick to what I know. So,
yeah. I mean, you're making a long-term bet in the technology,
oh, for sure.
essentially in the usage.
Mm-hmm.
Um, I mean, depends on what your investment philosophy is. Like some people will say, well, it's not a real tangible thing. In if there was a war, what good would your crypto do, right? Like it's not like real estate where it provides utility to the mankind where people can live in it,
Mm-hmm.
right? Now that might be a little bit of an old school mentality, right? I kind of prescribe to it a little bit, but at the end of the day, that's what investing is, right? You're putting your money into an asset. You're hoping that asset doesn't go down to zero, but you have a long-term prospects in it. And having the stomach to ride the ups and downs is kind of
Mm-hmm.
really what it's all about. But
Mm-hmm.
like I'll just give you some data points. Like wealthy folks, like we'll work with more higher net worth individuals, but even higher net worth people with 100 million, just use a round number like that.
Mm-hmm.
They may put like five. Crypto is considered asymmetric investment,
Absolutely. That's why I'm in
right?
it.
Yeah, but like these wealthy families, they may only do to give you a huge range, 1 to 10%,
Okay.
right? They don't need to take chances, but they still want exposure to the upside too.
Mm-hmm.
So 1 to 10% is what these guys will do. Now, as your net worth lowers, you may want to do more, I think. But There is no standard, right? I'm just giving you one data point for a very wealthy family
Hmm.
like
And
that.
and then for one thing that you said earlier in the interview is like investing in your business is one of the riskiest things. So I just want to ask you like what does your company do? What do you hope people do? And like what is I guess a challenge that you ran into with your business that you were able to overcome to get to where you are today?
Yeah. So what essentially in any investing, you got to gamble on something,
Hmm.
right? You got to put your foot on solid ground and bet on that ground's going to still be there. For the most part, we invest off of this theory that we like workforce housing, right?
Okay.
Our belief is that the rich are getting richer and the poor is getting poorer, and the middle class is going to be poor too in the future.
Hmm.
So we like this asset class of standard housing, not the nice, super nice stuff, not the crap too, but stuff that rents out between $800 to $1,200, right? That bell curve of America or lower middle class. That's workforce housing. So I believe that in the long term, in this sector, the population is going to be growing and demand is going to be strong 10 years from now. And that's kind of why we like to invest in this asset class. We're also doing value add to the assets, so fixing up units, bumping it up a little bit nicer to sell it for more. But um, at the end of the day, that's where we kind of put the flag in the ground and have that be the basis, right? No different than like if you're investing in crypto, it's going to go up and down, but you're making a
Right.
bet that this technology, for whatever reason, is going to be around in the future.
Hmm. And then the second part, which was like, is there? I mean, obviously, like it's risky betting on yourself and your business. Is there any particular moments like in your career that stand out where your back was against the wall and you were able to climb out of that?
Yeah, I mean, commercial real estate came down. It was a bloodbath in commercial real estate this last few years.
Hmm.
Came down 20-30% off the peaks, some even more. Um, I had a huge amount of my net worth, way more than half, in commercial real estate,
Oh wow.
and it was not fun. Um, but that's also how I got here to the first place. So I live with it, man. Like I like your attitude though. You don't invest in anything you can't lose,
Can't
right?
do it.
I'll
Yep.
come back to you once you lose it. You lose 90% of it, see where you're still is. But that's the attitude you need to have
Hmm.
going into it. And so I accepted that was the decision I made at the time. I still look back and I'm like, may still made a lot of sense. But I think as your net worth grows, you tend to become more diversified, and you try to invest in things that are counter cyclical or not really goes up and down with the market.
What are some of the biggest challenges when scaling a real estate business for that people could overcome? So, like, if somebody was trying to be a real estate investor, yeah, what are some challenges that people who are trying to get into real estate investing may face, and how can they overcome them?
I mean, the biggest thing is getting, if you're buying a rental property, is that what you're kind of?
Yeah, mainly for people that are trying to get into residential, for sure. Yeah.
I mean, you need 20% down payment.
Hmm.
That's the hardest part. Credit score of 600. That's what I did from 2009 to 2015, and then you just got to be patient. Originally when I started, again, I didn't really live in these places. Some of these properties I never even seen. I just use inspectors and realtors and property managers to be my set of eyes. But the biggest thing was just having the patience. Put down 30 grand to go buy $100,000 house, go back to work the next day for 6 months to a year, buy the next one, rinse, wash, repeat. It
Hmm.
just takes a long freaking time. Like this is not the get rich quick scheme. Like we're
Hell
not.
no.
This is not like crypto returns here, where you're making what is it annualized over the last 10 years, like 30%, something like that.
No, it's definitely more than that. Oh well, crypto
Yeah,
hasn't even been around for 30 years. It's only been, I think since 2012 or 11 is when Bitcoin started. So like 12,
yeah.
13 years.
I mean, in real estate, even if you're doing value add, I mean, you may see like low double digit returns,
Hmm.
right? But that also speaks, the low returns also speaks to the conservative nature and the risks, right? The more returns you get, inherently the more risks you're taking,
Absolutely.
right? There's a concept out there called the Sharpe ratio, that there's this kind of law, right? The more risk you take, the more returns that you should proportionately get.
What initially drew you to real estate to make this your primary vehicle for wealth building?
I mean, I just bought a house to live in because I blindly just followed what everybody told us to do. And then because I was traveling all over for work, I just decided on a whim to rent it out. And then I was like, holy crap, this works. And I think I got lucky with that. Like previously I had dabbled with stock trading, some options trading. I I lost money doing that. So maybe that was the best thing that could have happened, but this I got some early success in that. Which sometimes is bad, right? Like we all know
Yeah,
that buddy who likes to go and play slot machine in Vegas and actually wins his first time. Like that's the worst, right?
it
He's
is the
hooked for
worst.
life.
Hmm.
In a way, crypto's kind of like that, buddy.
Kind of. I mean, that pretty much. That's how it was. Like, everything was going up. Didn't know what I was doing. Thought I was on top of the world. Then it came down. Got liquidated. Lost it all. And I was like, all right, well. And like me and my friend, we were kind of like in it together, and we always say that losing it all was probably the best thing that would that happened to us because through losing everything, it forced us to like take a step back and actually like learn the shits as opposed to just, if everything went like if, our first super high leverage trade ended up working out, then we wouldn't have ever learned anything. We would have thought we were on top of the world and all this other shit. And we would have eventually lost everything. We would have just lost it all later. You know what I mean? So I'm glad that that didn't happen. And I'm doing it the right and the safest way possible at this point. Not
Yeah.
saying that
I mean,
things can't go wrong, but yeah.
I will say something like, not to be argumental because it's your freaking podcast, right? But
No, it's all good.
a wealthy guy did tell me, like, at the end of the day, wealth comes to those people who create value,
Hmm.
right? Like people who create very successful businesses and create a lot of money. Their businesses create value for people. That's why people freaking pay them.
Hmm.
Real estate creates value for people, right? There's a difference between value creators, which again, wealth comes to them, and people who trade things back and forth that don't really add value to the system, right? And at the end of the day, do you want your life to be defined as somebody who just traded things back and forth or created value into the system and played the long game, right? At the end of the day, you're just one trade away from making it huge or
Hmm.
losing it. Where I think that, I guess what I'm saying is like try to find something that adds value to the world as a more pragmatic approach to this wealth building.
Hmm. And it's crazy. Like, it's actually funny that you bring this up because I had what I'm about to say. I had this same conversation with this one of my friends I was at lunch with, but I don't disagree with what you say. I think that if you want to live, a holistic, fruitful life, you can't just be, just about you. Like making $100 million in in crypto, the stock market, and then just giving it to no one, like, and then not contributing to society. But for me, what I plan on doing is like, like I also have my own business where I help, content creators and influencers with their content and stuff like that. So I am doing that. But in terms of like the crypto stuff, that's where I plan on making a lot of my money for within the next 1 to 2 years. And what I plan on doing is investing it back into things like the podcast, things like the business, build up my influence, and then once I have wealth, be able to invest in different initiatives that I believe in and stuff like that. And the reason why that that conversation even came about is we were talking about you know I think we were talking about boycotts and protests and all this other stuff. And I basically told her that like what I'm trying to do is build myself up, get the influence, and then be able to have a bigger impact as opposed to all the all the other stuff that people are doing nowadays. But
Yeah,
yeah, but
yeah.
I don't disagree with with that statement in terms of building value and helping people. I
Yeah,
definitely
no,
agree with that.
I'm glad you point that out because I mean there's some people that they just invest in, whether it's crypto or stocks, right? Like there's not really I mean, I guess you're jumping on the bandwagon, but I mean, I think there's always two sides of this, right? The passive investor side
Hmm.
where you might invest in real estate or crypto, but then the other side is like you got to put in the sweat equity. You got to create something, create value. Again, wealth
Hmm.
comes to those people who create value.
Absolutely, don't disagree. So when I asked you about one of your most difficult times, you talked about how your commercial real estate went down like 20-30%. So what were some things that you did during that time to kind of like hedge yourself or protect your wealth during those times? Or did you just write it
Well,
out?
I mean, essentially, it is kind of writing it out, right?
For
I
sure.
mean, some projects just don't make it,
Hmm.
right? It's unsavable, right? Because you're going to have to put in a lot more money to see the market come back, right? For the market to come back half of where it was, it may take 5 to 7 years. And to get to that point, it's, you're going to have to put in millions of dollars, and that money doesn't make any ROI on it.
Crazy.
So, I mean, there's a lot of very difficult decisions, right? I mean, it's very much like war. Are we going to amputate this arm to save the body, essentially? And it comes down to like diversification. Thankfully, it's just dollars, right? We're not talking about human lives here.
Right.
But exactly like you said earlier, you should never invest your money if you can't afford to lose it. Never.
Never, never, ever. No, it doesn't matter who's like, even if they guarantee you, all these, fund managers and stuff, they're gonna guarantee you certain returns, and their reputation might be great, but always gotta think about what will happen if this goes to zero. That's what I always think about. And and the thing is like the reason why I went so heavy in crypto is because at the time I was like, I think 25 at the time when I really, or 24, 25 when I first started like really investing, and I was like, look, if this doesn't work within the next 4 to 5 years, I'll still be in my late 20s, like early 30s. You know what I mean? So it's like it literally makes the most sense to do this. Like even
Yeah.
if it
And
goes
I
to
think
zero.
I totally buy that too, right? Like, I mean, there are, even in the world of real estate, there are like more riskier plays that you can make way more returns in.
Hmm.
And then there are other investments where, maybe you just lend money out as a debt investor, get like 10%, 12% per year.
Hmm.
The upside isn't there in that, obviously. So, you can get like if you think of a graph, right, you can get from this point to this point two ways. You can, or an infinite amount of ways, but for the most
Infinite.
part, two
Yep.
contrasting way. You can go this way here, or you can go that way here. So what I mean by that is like you can be really risky in the beginning and then cruise the rest of the way, or you can, you know, be conservative for a gazillion years and then risk it all at the end.
Yeah.
So there's kind of two binary ways of going about it with an infinite amount of possibilities in the middle. But I mean, I'm not saying, I'm not a certified financial planner, so what the hell do I know, right? I'm
Absolutely.
not a
Hey,
guy
none
who
of this is
sells.
financial
I'm
advice.
not a guy who sells marketable securities here.
Hmm.
But I hear your logic, man. I
Hmm.
mean, if no biscuit if you don't risk it, as they say. Right?
Oh,
I mean, that's
absolutely.
the same reason why, like, when you're younger, you want to start the business when you're younger, so that when you eventually do strike out and go bankrupt, you can start it again with all this learned stuff that you learned.
Absolutely, and that's the thing too is like, I'm sure you're familiar with Alex Ramosi, but was I watched his content line. One thing he said is like, you know what, like I'm not paraphrasing, but he was basically saying like, look, like you're not gonna regret having cool stories. You know what I mean? I'll have a cool like if it doesn't work out, I'll have the lesson and I'll have a cool story. Be able to say like, hey, I went all in crypto and did X, Y, and Z, and my life was crazy and I lost it all, but I'm still okay. You know what I mean?
Yeah, yeah,
Or
and I'm sure like David Goggins, right?
mhm. Oh
Um,
hell yeah.
yeah, I was watching a video the other day, and he was like, when he was super fat, he said he was like thing he remembers is like he was running around a graveyard,
Mhm.
something like that, and he was like, how many people in that graveyard never really went after it, and the regrets, and he
Exactly.
still had time, right?
Mhm. Exactly. And that's me. Like I really just I don't want to get to the end and realize I think it was either Alex Becker or what's his name? Sam Ovens said like they called it the ultimate hell. And the ultimate hell is basically where you've reached like a certain point in your life or like you reached not necessarily the end, but maybe like you're so far in your life that like you don't have much time left or you can't really go back and change anything and you're just like stuck and you have all this regret, maybe decades of regret of things that you could have did. And I was like, damn, like that can't be me. I can't. I
Yeah,
don't
yeah,
want
you're a
to.
well-read for
Mm-mm.
sure. Yeah, they say there's more, there's more emotion wrapped up in regret. Like there's more roses at a gravesite than, when you graduate, is what they say, right? Something like that. And it kind of says, well, there's more emotions and like the regret. So if you kind of use that as fuel to have you kind of go after it, instead of just playing what most people do. I mean, I see it firsthand. Like most of my clients are over the age of 50. They are
Yeah.
not, you know, th- I mean, I'll be frank with it. They're most of the years are behind them. If anything, that they only have less than 10 years to live.
Hmm.
Even if they went after it now, they gotta they gotta stress it out for 5 years, and then what maybe 5 more years left. That doesn't make
Crazy.
any sense.
Yeah.
Makes absolutely no sense. Um,
And that's what I was
so
talking about. They're just and now they're just gonna just do stuff that like they might have a cool life, but they might not live the life that they actually wanted. So.
yeah, so they live the life of the quiet desperation, as they say in these books, and they just kind of keep on with the status quo. And I think, but that's what's hard, right? Like most of my clients have the what we call the golden handcuffs. They make a
Mm,
high salary. It the To quote another book, the enemy of great is good, right? They
yep.
have a good life, but it's hard for them to take a chance to somewhat risk it, even though they could probably more than recover to go after that great.
Well, I'm glad we had this dialogue. I know we kind of strayed away from the real estate, but that's definitely important for the people to hear that to really go after it, not be scared to go after what you want. You know what I mean? We only have a finite amount of time on this planet, and you'll never know when your time is up. Like actually, literally, like a week ago, unfortunately, like one of my yeah, he was at Howard University the same year as me, but I was a senior when he was a freshman. I just found out. I got on Instagram one day and I found out he passed away. And he was 24. I was like, "Fuck!" Like, you know what I mean? Like, you never know. Like, you never know. Like, when your time is up, and you gotta live life to the fullest, and not, you know, like you said, just live a good life
Yeah,
and be in those
yeah,
golden handcuffs.
yeah. I mean, at the same time, too, if you have enough, then own it, right? You don't need to start a business. You don't need to invest.
Hmm.
Some of my clients are like that. There's a good book by Bill Perkins. He was on my podcast. That he wrote a book, Die with Zero. It's very popular.
Mm.
But if you're under $2 million net worth, do not read that book, please. Absolutely do not read that book.
Bill
but
Perkins.
um, but yeah, very popular book within our community for
Hmm.
sure.
Hmm. Was you gonna share some insights from the book or what?
Do not read it if your net worth is under 2 million.
Don't read it. Okay.
Don't read it.
Cool.
Don't read
Well,
it, Miles. Don't read it.
I
No,
won't.
you
I
want to read
won't.
it?
I got. Nah. No. I'll take your word for it. Let me get my net worth to 2 million. Ain't there yet. Ain't there yet. Not yet though. So if you could go back and start over, what would you do differently in your real estate journey?
I mean, I think I did everything how I could have done it. I had a good paying job. I saved up a bunch of money a year, just plotted into rental properties. Maybe I could have done a little bit faster, but I didn't want to take on more risks. I was risk intolerant at the time. I had a good life.
Any next plans for? I mean, either you personally or the business?
We are looking to get into more private equity deals in the future, so kind of taking a step off of real estate. If you know, I'm sure, like you said, you check out what's happening with the Fed all the time. They're probably not going to lower the Fed rate under 3 or 4 in the next decade, is what they're projecting. So with real estate, you need good interest rates and loan the values on those loans. So I think the gone are the days of the 2010 to 2022 era. So that's why, real estate may not be the best place anymore with the trade winds that people enjoyed at one time, the trade winds that we enjoyed at one time. So where we go for yield, right? We're searching for alpha. It's buying businesses from people who have been retiring. All the stuff that Alex Hormozy talks about, right? But he's talking more to the operator. We're talking more about the investors buying those assets up.
Oh yeah, and then I saw that you had a YouTube channel, so I wanted to ask you, how has making content been for your business? Have you seen an uptick in clients? Like how's been making content been for you?
Yeah, I mean, I think I got lucky. I started the podcast back in 2016,
Oh
so we
wow.
were able to build a community. Back then, I do think it's a lot harder, if not impossible, especially in the financial space, to build a platform. But
Really? Why is that?
um, just everybody does it.
Mm,
There's a gazillion other options, and it gets lost in the noise. A lot of B2B podcasts these days too. Last several years too makes it even more difficult. I mean, so, but it always it's a constant change, right? The
mhm.
courses always change, especially in the marketing world.
And then how, because you said 2016, so you've been, it's almost 10 years. So
Yeah, almost
what
10 years. Yeah.
yeah, it's crazy. And they say that, podcasts, most people don't make it past episode like 3. And then if you make it past episode 3, like 90% of those podcasts don't make it past episode 20. So how did you stay consistent with your content, or what drove you to continue
I mean, you
going?
almost need to be an idiot to keep doing it, right? To get past episode 100. Because until then, you don't know. Even if you're good, you don't know it.
Yeah.
But I got past 100 and I was getting a lot of like feedback and fan mail. So like I knew it wasn't terrible. I mean, we still do it today.
Mhm.
But um yeah, if I wouldn't have that feedback loop, I probably would have stopped at episode 100.
Yeah, that feedback is definitely crucial. And then what's the name of your podcast? I don't think you mentioned it.
The wealth elevator.
The Wealth Elevator. Yeah, everybody check out the Wealth Elevator. Is it audio, video? What is it? Or
Both. Yeah, both.
both?
Yeah.
Cool. Sweet.
Yeah. You got to do it
Well,
on YouTube too, right? YouTube has surpassed iTunes as the number one podcast player as of a couple of years ago.
yeah, absolutely. Like when I started my that's why when I started my podcast, like I started with video. And I remember I went to a conference and they were talking about like, hey, like if you have a podcast and you're not on video, you need to get on video because like, YouTube's taking over. People want to like put names to faces and want to see like people interact and stuff like that. So I was like, hey, what did you always start with video, or were you audio only at a certain point?
I think I was always video.
Oh,
I
okay.
mean, it
Oh
doesn't
wow.
take too much effort to
Yeah,
do it
I'm saying.
too, right?
Yeah. I mean, it depends. Like if you, because I know some people that like strictly only do like in person interviews. I don't do that because I think, especially if you're just starting out, like it limits the amount of pool of people that you can talk to. Like there's so many cool people, and it's like, you know what I mean. Unless you want to, pay for guests to come on and fly them out and stuff like that. Um, but yeah, I would say that, if you're looking to start a podcast, one, you gotta get to at least 100 episodes before quitting, and then start with video. So, and then is there anything you want to leave the audience with before we close out?
Um, no, I mean, I guess if people are, credit investors, certainly do reach out. But I certainly think, yeah, check out my book on Amazon, The Wealth Elevator. I think it kind of gives a good overview of, the kind of the floors of the wealth building journey, and we kind of touched upon it a little bit today. But I think it is somewhat inspiring to kind of know that there's different steps out there, and it's not just a one size fits all formula.
You're talking about one size fits all when it comes to wealth.
Yeah. Yeah, like for example, Susie Orman, Dave Ramsey, these guys, that's great for people getting out of debt, right? But there comes a point where you adopt the rich dad, poor dad mentality, but then that's where the wealth elevator kicks in for the upper floors from there on out.
Perfect, perfect. All right, man. Where could people find you? I know you shouted out the Wealth Elevator podcast, but where could they? What other social medias or do you have?
Yeah, just Google us. We've been around.
Like that, like that. Hey, I'll find the links and I'll put them in the description. But thank you, Lane, so much for coming on the podcast and dropping these gems. I hope you guys learned some about wealth creation, real estate, all that stuff, and was motivated to get after it. And until next time, peace.